But is breaking up always a positive for shareholders? We've got two relationship experts here, Ron Insana, a senior advisor at Schroders North America, and Herb Greenberg, senior editor at Empire Financial Research. Both are CNBC contributors. Welcome, guys. So let's answer that key question first. Do breakups benefit shareholders generally in the long run? Ron, you go first, and then Herb jump in.
Yeah, I think so. And Tyler, this is, as we all know, we've all been doing this for quite some time. We've gone through these conglomeration periods and de-conglomeration periods for quite a number of decades. You know, in the 60s, it was Gulf and Western and IT&T. And then in the 80s, we went through a merger mania. And a lot of this is deal flow coming off Wall Street, putting together companies sometimes that don't naturally fit. And then when it stops working as a model, given changes in the environment, the companies get broken up and spun off again. And a lot of times, you know, one of the single spinoffs might be the big winner for shareholders when they do these tax-free distributions. We saw that with AT&T when it broke apart. We've seen it in other instances as well. And there are periods where everybody's hot for a deal, and then there are periods where people are really hot to break up the very things they put together. A lot of it's fee generation for Wall Street.
Exactly. We'll come back to that one in just a minute, Herb, because that's what fascinates me, the role of the investment bankers in the putting together and then the breaking up. But let's bottom line the viewer here. For those who are holders, for example, of General Electric or of Johnson & Johnson, do they do better post-breakup?
Historically, I would say sort of yes. It depends on the company. And if you look at GE, look what investors are telling you today. After the initial euphoria over the news, the stock over the past few days has been sliding down. So, you know, I think it really depends on the company, Tyler. And I think there's no surefire here. What we know is they're great headlines. And beyond that, it's Wall Street doing what it does best. And by the way, breaking up is so easy to do.
When you got a banker, sure, yeah, definitely, it's easy to do. Just pay him, and that's why these bankers are rejoicing. But Ron, when you see these headlines and you see them in such repetition, so many breakups announced in such a short amount of time, it makes you think that we're maybe at a certain point in the market cycle for this to happen. It almost feels, I mean, I don't know about you, it feels almost like it's signaling some sort of a top. This only happens when things are really good.
Yes and no. I mean, we can also argue the flip side, Melissa, which is that, you know, when you see merger mania hit, which we're in the midst of as well, where merger volumes are above prior records, that also is somewhat indicative of a top. I mean, I'll worry more about a top when the Fed changes policy. But yeah, it's somewhat late cycle behavior. I would take GE out of that altogether. It's a company that should have been broken up 20 years ago. In fact, I interviewed Jeff Immelt when he first took the job from Jack Welch, and he said he was never afraid of the law of large numbers. And yet GE at the time had a $600 billion market cap, $200 billion in revenues, and there was just no way to grow it and make that model work. And right into the great financial crisis, it became wildly uneconomic. And I think that was true for a lot of these combinations where the sum of the parts may not have been greater than the whole, and they were mismatched to begin with. And so I think a lot of this is just the result of some bad ideas that were unsustainable in the long run.